Imagine a scrappy restaurant that built the neighborhood's best midnight pizza for years. Customers lined up. Then two big chains opened across the street with fancier ovens, deeper pockets, and enterprise loyalty programs. Suddenly your orders stay steady, but your margins are getting chewed up by discounting. That's Supermicro Computer, SMCI, in a nutshell, a once dominant specialist in AI servers and modular systems now wrestling with pricing pressure, analyst skepticism, and the classic tech industry question: grow fast at the cost of margin, or defend margin at the cost of share. Supermicro Computer, Supermicro/SMCI, designs and sells a broad range of server and infrastructure products: twin, big twin, systems, multi-node MP servers, GPU/coprocessor boards, microcloud, AMD, and GPU-based super servers, power supplies, storage, super workstations, motherboards, chassis, super rack, and server management software. Those product pages are the factory for its AI server reputation. The company was founded in September 1993 by Charles Liang, Yishayan Lao, Sarah Liu, and Chiu-Chu Lu Liang, and is headquartered in San Jose, California, a Silicon Valley origin story with roots in board-level engineering. What Supermicro actually does, so we stop calling it just a server company. Supermicro builds and sells modular server hardware and systems that are used by cloud providers, enterprises, research labs, and AI builders. Their catalog reads like the parts list for modern compute: dense multi-node, twin, servers that cram many CPUs into small rack space, MP, multiprocessor, servers for heavy back-end workloads, GPU/coprocessor server boards and chassis for AI training and inference, microcloud systems for edge and telco use, complete AMD-based solutions and super server lines, high-capacity storage arrays, and management tools for the whole stack. In short, they sell the physical racks and the building blocks, the stage, speaker stands, and even some sound tech, that allow AI workloads to run. Why that matters: OEMs and hyperscalers don't just buy chips, they buy validated systems that can be deployed at scale with predictable thermal and power characteristics. Supermicro's strength historically has been speed and customization. They can design and ship tailored server systems faster than many larger incumbents, which made them a favorite when customers needed aggressive density and flexible configurations. But speed alone doesn't guarantee sustainable pricing power. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. The founders and the origin story: basic credentials, big ambition. Supermicro's story begins in 1993 in Silicon Valley. Founder and CEO Charles Liang and co-founders, including his wife Sarah/Chiu-Chu Lu and Yishayan Lao, started from motherboard design and small-scale manufacturing, then scaled into full systems as the server market exploded. The company grew from designing motherboards to supplying full rack systems, a pivot many tech entrepreneurs dream of but few execute cleanly. Today their San Jose HQ is the nerve center for a global supply and manufacturing footprint. This background explains why Supermicro is still seen as an engineering-first firm rather than a pure channel play. The recent news that spooked traders: Citi's price target cut. On the market front, the splashy, immediate news was that Citi analyst Asia Merchant cut her price target for SMCI from $48 to $39, while keeping a hold rating. Newswire coverage summarized the move as a sentiment dampener that coincided with a day of downward pressure on SMCI shares. Analyst price target moves tend to be short-term catalysts: they change headlines, some fund allocations, and the behavior of algorithmic screens that watch for momentum. In practice, a single analyst cut doesn't decide a company's fate, but it can accelerate negative sentiment, especially when the name is already trading in a volatile groove. Why analysts still see upside into the mid-$40s, and why 3-year targets are fuzzy. Despite the near-term cold shower from the Citi note, consensus 12-month targets across analyst panels still cluster around the mid-$40s, investing.com/stockanalysis/Zacks averages float in the mid-40s range. Those 12-month targets reflect a mix of expectations. Some analysts buy the story of persistent AI demand and feel Supermicro can ride the wave, while others discount the multiple risks: pricing, component cycles, customer concentration. 3-year targets are rarely published as firm numbers because long-term forecasting in hardware is so contingent on product cycles, foundry capacity, and macro demand. So you'll see a lot more 12-month talk than precise 36-month math, and that's why investors should treat multi-year price calls as scenarios, not certainties. Pricing pressure: why the margin fight is the main event. The heart of the worry behind the analyst cut is pricing and margins. Supermicro's revenue growth over recent periods was strong, AI demand helped, but margins have felt the squeeze as larger incumbents and system integrators, Dell, HPE, Lenovo, and cloud builders, aggressively target AI infrastructure customers. Big players have two advantages in price wars: they can bundle services/support, and they often can accept lower margins for strategic reasons, cross-sell, services, or locked-in cloud deals. When that happens, a nimble hardware vendor like Supermicro faces a choice: keep prices high and lose share, potentially missing the scale customers want. Drop prices to keep racks moving, but accept lower gross margins. SMCI's business model, which historically thrived on custom, high-density systems sold at reasonable margins, becomes more fragile when the market commoditizes. That's the background for analysts calling out margin pressure and trimming targets. Another feature of SMCI's story is customer concentration. A handful of hyperscalers and large cloud customers drive outsized orders, big rack buys, which makes revenue lumpy. One big purchase or pause can swing quarter-to-quarter results. That's great on the way up: huge orders equals big revenue, but dangerous on the way down: delay one order and you miss guidance. Analysts pay attention to this because concentration increases execution and visibility risk, and it makes judge and jury moments, like delivery cadence or chip transitions, more important. However, we could expect Smci to hit above $100 in 3 years. Note this as well. It is written in Revelation 14 verse 7 that, "Fear God, and give glory to Him, for the hour of His judgment is come, and worship Him that made heaven, and earth, and the sea, and the fountains of waters." I appeal to you to fear God and obey His law. For His commandments are sure and His word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: "I stayed until the end." Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe, and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel, and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch, and pray. See you in the next video according to God's will.